On September 15, 2008, the global economy was suddenly plunged into an abyss. Why did no one foresee or prevent this catastrophic collapse? Trillions of dollars in wealth were lost worldwide. Millions lost their jobs, and social infrastructure in many countries teetered on the brink of collapse. Yet, beneath this worst-ever economic crisis lay human psychological and structural issues that continue to repeat even today. What was its true nature? This video thoroughly explains why the housing bubble burst, who overlooked what, and what lessons it holds for today. Let us now delve into the full scope of the Lehman shock that devastated the world. This main feature also provides a detailed explanation of the policy decisions behind it. In the early 2000s, the U.S. was experiencing an unprecedented housing boom, fueled by low interest rates and policies promoting homeownership. Everyone believed in the American dream. Financial institutions aggressively offered subprime loans to borrowers with poor credit. Initially, these were seen as innovative products invigorating the economy. Subprime loans were securitized, transforming into complex financial products known as MBS, mortgage-backed securities. Promising high returns, they attracted investors worldwide. Further subdividing MBS, CDOs, collateralized debt obligations, supposedly designed to diversify risk, emerged. Rating agencies gave them high assessments, creating a myth of safety. Banks and pension funds worldwide eagerly purchased CDOs. Their demand exploded, seeing them as a magic wand, offering high returns with low risk. Housing prices soared endlessly. Borrowers took out loans to buy homes, then sold them for profit when prices rose, or refinanced into new loans. This system was based on the optimistic premise that housing prices would never fall. The financial market was engulfed in euphoria, and profits continued to expand relentlessly. The global economy was interconnected, and the booming U.S. housing market became a driving force for worldwide growth. Everyone believed this prosperity would last forever. Wall Street's geniuses claimed they were managing risk by using advanced mathematical models to subdivide and restructure loans. Despite offering higher yields than traditional financial products, they were advertised as having diversified risk and high safety. This was a major attraction for investors. Rating agencies certified MBS and CDOs with top ratings like AAA. This made even more institutional investors feel safe to invest. Governments worldwide also promoted deregulation of financial markets, supporting the circulation of these new financial products. International capital flows intensified, accelerating economic growth. Financial institutions generating immense profits were lauded as drivers of the economy. Their success was seen as a triumph of new financial engineering. Hedge funds and investment banks engaged in massive speculation with high leverage, earning enormous profits in short periods. Their perception of risk became numb. Loans were even offered to people who couldn't previously own homes, promoting homeownership. This was seen as having a positive social impact, and criticism was minimal. Up to this point, everything seemed fine. The global economy, on the surface, appeared to be entering a new era of prosperity thanks to this financial innovation. However, when the Federal Reserve began raising interest rates in 2004, the situation drastically changed. Repayment burdens for adjustable-rate subprime loans started to skyrocket. Rising housing prices gradually slowed, eventually flattening. As collateral values dropped, borrowers found themselves unable to repay their loans even by selling their homes. Many subprime loans, issued with negligent screening and little consideration for repayment ability, began to default. The surging default rates severely diminished the value of MBS and CDOs. However, these risks were hidden within complex financial products, and no one could accurately grasp them. Rating agencies had a structure where they received fees from financial institutions, making their assessments lenient. They continued to overlook the escalating risks. Financial institutions also engaged in accounting trickery, such as transferring MBS and CDO risks off their balance sheets to special purpose vehicles, SPVs. Everyone pursued profits, turning a blind eye to the chain of risks. The overall market euphoria drowned out individual warning signs. But here, a trap opened that no one noticed. Its depth far exceeded imagination. Financial institutions feared being left behind while competitors made enormous profits. This was a classic case of groupthink. Already, enormous funds had been invested in subprime-related products, trapping them in the sunk cost fallacy, a point of no return. Due to the complexity of financial products, even top executives didn't fully understand the risks. Information was fragmented, and accountability was vague. Massive bonuses accelerated the pursuit of short-term gains. Executives and traders were motivated by immediate incentives rather than long-term risks. Regulatory authorities, too, were constrained by financial institutions' lobbying and the philosophy of leaving it to the market, failing to implement effective measures. Regulatory delay was fatal. The too-big-to-fail notion encouraged financial institutions to take excessive risks. There was an implicit understanding that the government would ultimately bail them out. Even if someone sounded the alarm, their voice was drowned out in the vortex of immense profits. Optimism and greed propelled them down the path to ruin. At this rate, it would not merely be a housing loan issue. The financial system itself was beginning to tremble, a fact almost everyone failed to notice. In 2007, the subprime problem became apparent. In March 2008, investment bank Bear Stearns collapsed, sending shockwaves through the market. Then, on September 15, 2008, Lehman Brothers, a symbol of Wall Street, filed for bankruptcy. The world watched a financial giant crumble before its eyes. The collapse of Lehman Brothers pushed credit anxiety throughout the financial system to its extreme. Interbank lending froze, leading to a credit crunch. Financial institutions worldwide, holding massive amounts of MBS and CDOs, faced successive crises. AIG was barely saved by a government bailout. Corporate fundraising became difficult, halting capital investment and new ventures. Stock prices plummeted worldwide, and a severe recession spread to the real economy. Governments worldwide responded with massive monetary easing and fiscal stimulus, but the scars ran deep, forcing the global economy into several years of severe adjustment. The Lehman shock starkly demonstrated how destructive excessive market optimism, regulatory failures, and the chain of risks created by complex financial products can be. Even in modern society, the easy pursuit of profit and group psychology can create new bubbles. We must constantly continue to learn from history. In this video, we explained why the housing bubble burst. Its background lay in low interest rates and policies promoting homeownership. Who overlooked what? Financial institutions, rating agencies, and regulatory authorities all overlooked the risks created by negligent screening and complex financial products. And the lesson for today demonstrates a universal truth. Rather than relying solely on market principles, transparency and sound regulation are always crucial. The quality of economic decision-making will be vastly different for those who understand this failure and those who do not. We must apply this lesson to the future. The history of failure is never merely a thing of the past. It is always a mirror reflecting our own future.